So if you're a real estate investor, of course, one of the big bugaboos is real estate taxation. And how do you maximize the tax benefit of your real estate investment? Hello, my name is Paul Carroll, the CEO and founder of Avion Wealth, an elite wealth management firm here in South Texas. To an extent, almost all of us are real estate investors, even if we're not thinking about it. As a homeowner, you're enjoying a mortgage interest deduction, probably, and a property tax deduction. There are limits, there's a $10,000 cap here, $1 million mortgage there, but in essence, even a homeowner is getting some kind of tax break. And should you sell that house, between $250,000 and $500,000 in capital gain can get rolled into a future house. All good reasons, if you're staying put, to consider real estate for your residence, because it's also an equity building tool. However, real estate investors, in addition to these breaks, can depreciate the property and enjoy other much more sophisticated benefits. Depreciation is the magic word here. When you own a building, you can depreciate that building over 27 and a half years if it's residential, or 39 years if it's commercial. That's a straight deduction off the income from your property. Now, there are passive activity rules. I'm not going to get into those. But in essence, at a high level, passive activity rules determine, are you a professional investor or is this a passive investment that you're doing on the side? And it affects, can you write off these costs against your real estate investment or other ordinary income? For these conversations, we're going to assume these are passive activities. The interior of a building, anything that's non-structural, can actually be depreciated over 5, 7, or 15 years using modified accelerate cost reduction schedules. And to figure out how to maximize depreciation is something called a cost segregation study. We work at Avion with a number of professional partners that can run cost seg studies. Cost seg studies make most sense for larger commercial investments, warehouse properties, factories, plants, retail space, things like that. So depreciation is a great advantage. Being able to take depreciation against your earnings reduces the tax footprint of the investment. But there's a gotcha hidden in it, and it's called depreciation recapture. And a lot of people do not understand that when you depreciate a property that you actually will sell for more, you're not getting a tax break, you're really getting a tax deferral. And you got to pay those gains back. Because what happens is that depreciation accumulates. When you sell a property at a gain, the IRS says, well, then it's not depreciated, is it? We want to recapture that depreciation and tax you at 25%. So we can see an arbitrage opportunity. If you're in the 37% tax bracket, you're like, okay, it's not perfect, but it's not bad. If you're in a 15% tax bracket, that can actually mean you're having a negative long-term impact. In addition, you have capital gains and any subsequent gain in the value of the property. And capital gains are at 20%, but you also get other, Medicare tax and some other things depending on the situation. So the trick with real estate is to maximize the tax advantage. Is how do we defer those gains, ideally, until you pass away, until you get a step up in basis. And now there are other strategies to literally wipe those gains out. We'll talk about those. So of course this stuff is fascinating if you're a real estate investor, and especially if you're one trying to mitigate taxes. But it's about as exciting as watching paint dry if you're not. Assuming you're a real estate investor and not trying to get to sleep tonight, we wish you the best of investment and real estate investment success.